My dear students, welcome back to our channel. In this video, I will be explaining the Bcom third semester subject Advanced Accounting as prescribed by Osmania University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 2 first important short question is: what is meant by insolvency of partner? Insolvency of a partner means that the partner is not able to pay his debts or meet his liabilities. In simple words, when a partner's liabilities are more than his assets and he cannot bring money to pay off what he owes to the firm at the time of dissolution, he is said to be insolvent. When this happens, the loss due to the insolvent partner's deficiency, the amount he cannot pay, is shared by the solvent partners according to the rule of Garner versus Murray in their capital ratio. Example: A, B, and C are partners. On dissolution, C's capital shows a debit balance of 3,000 rupees and he is unable to pay. If A's capital is 10,000 rupees and B's is 5,000 rupees, then A and B will share C's 3,000 rupee loss in the ratio of 10,000, 5,000 is equal to 1. In short, insolvency is equal to partner unable to pay others bear his loss. Next important short question is: to explain Garner versus Murray rule. The Garner versus Murray rule is an important rule in partnership accounting used when one partner becomes insolvent at the time of dissolution. It says that the loss due to the insolvent partner's capital deficiency should be shared by the solvent partners in the ratio of their last agreed capitals, not in their profit-sharing ratio. This rule applies only when the firm is not governed by any special agreement and when at least one partner is solvent and others are insolvent. Example: A, B, and C are partners. Their capitals are 30,000 rupees, 20,000 rupees, and 10,000 rupees respectively. On dissolution, C is insolvent and cannot pay his 6,000 rupee deficiency. According to Garner versus Murray, A and B will bear C's 6,000 rupee loss in their capital ratio 30,000, 20,000 is equal to 3:2. So, A bears 3,600 rupees and B bears 2,400 rupees. Easy tip: Garner versus Murray is equal to insolvent partners, loss shared by solvent partners in capital ratio. Next important short question is: 3. What do you mean by revaluation account? A revaluation account is a special account prepared when there is a change in the partnership structure like admission, retirement, or death of a partner to find out the profit or loss due to the change in value of assets and liabilities. It helps partners to know the true worth of the firm's assets and liabilities before the change takes place. If the value of assets increases or liabilities decrease, profit credited to partners. If assets decrease or liabilities increase, loss debited to partners. Example: suppose the firm has machinery worth 50,000 rupees and its current value is 60,000 rupees. The gain of 10,000 rupees is shown on the credit side of the revaluation account. Easy to remember. Revaluation account is equal to check the new value before a change. It ensures fair adjustment of profits or losses among the old partners before the new partner joins or one retires. Next important short question is: 4. What is purchase consideration? What are the methods to calculate it? Purchase consideration means the total amount paid by a purchasing company to a partnership firm when it buys the firm's business. It is the price of the business, and it can be paid in cash, shares, or debentures, or a mix of these. In simple words, when a firm sells its assets and liabilities to a company, the company gives something in return. That payment is called purchase consideration. Example: if a company takes over a firm's assets worth 5 lakhs rupees and liabilities of 1 lakh rupees, the purchase consideration may be 4 lakhs rupees. Methods to calculate purchase consideration. 1. Net assets method. Purchase consideration is equal to agreed value of assets, agreed value of liabilities. 2. Net payment method. Purchase consideration is equal to total of all payments made by the company, cash, shares, or debentures. Easy tip: purchase consideration is equal to price paid for buying the firm's business. Next important short question is: question. A and B are partners and decide to dissolve their firm. Assets realized 80,000 rupees. Liabilities: creditors 45,000 rupees. Loan from A 20,000 rupees. A's capital 10,000 rupees. B's capital 15,000 rupees. Show realization account. Step-by-step explanation. 1. Purpose. Realization account is made at the time of dissolution to find out profit or loss when all assets are sold and liabilities are paid off. 2. Record assets. When assets are sold, cash received is entered on the credit side of realization account. By cash, assets realized 80,000 rupees. 3. Record liabilities. When liabilities are paid, the amount is shown on the debit side. To creditors 45,000 rupees. 4. Find profit or loss. Profit is equal to 80,000 rupees to 45,000 rupees is equal to 35,000 rupees. This profit is divided between A and B in their profit sharing ratio, assume 1:1. Realization account. Particulars. To creditors 45,000 by cash, assets realized 80,000. To profit, A's capital 17,500. To profit, B's capital 17,500. Total 80,000. Note: loan from A 20,000 rupees is a separate liability paid directly to A, not through realization AC. Easy tip: realization is equal to realize assets, pay liabilities, share profit or loss. Next unit 2. Long questions. First important long question is: 1. Explain the treatment of unrecorded assets, liabilities and realization expenses in the case of dissolution of firm. Answer: when a partnership firm is dissolved, all the assets are sold and liabilities are paid off. Sometimes there are items not recorded in the books, unrecorded assets or liabilities, and also expenses to close the firm. Let's see how they are treated one by one in the realization account. 1. Unrecorded assets. These are assets which are not shown in the balance sheet, but the firm owns them. Example: an old computer, fully written off furniture, or unrecorded investment. Treatment. If an unrecorded asset is sold, the amount received is credited to the realization account. If an unrecorded asset is taken over by a partner, the agreed value is credited to realization account and debited to that partner's capital account. Example: unrecorded furniture sold for 2,000 rupees. Journal entry: cash ACDR 2,000 rupees. To realization AC 2,000 rupees. To unrecorded liabilities. These are liabilities not shown in the books, but which the firm must still pay. Example: outstanding wages, unrecorded bills, or unpaid rent. Treatment. If the firm pays an unrecorded liability, it is debited to the realization account. If a partner agrees to pay the liability, the amount is credited to realization account and debited to that partner's capital account. Example: unrecorded wages 1000 rupees paid. Journal entry: realization ACDR 1000 rupees. To cash AC 1000 rupees. 3. Realization expenses. These are expenses incurred to sell the assets and close the books of the firm. Example: legal fees, commission to agent, transport charges, etc. Treatment: if the firm pays the expenses, debit realization account. If a partner pays on behalf of the firm, debit realization AC, credit partner's capital AC. If a partner takes responsibility for fixed payment, only that agreed amount is debited to realization AC. Example: realization expenses paid 2000 rupees. Realization ACDR 2000 rupees. To cash AC 2000 rupees. Easy tip to remember: unrecorded assets add to realization, credit. Unrecorded liabilities subtract from realization, debit. Realization expenses always on debit side. This ensures a fair calculation of profit or loss on dissolution. Next important long question is: 2. What is dissolution of firm? Explain the circumstances under which a firm can be dissolved. Meaning of dissolution of firm. Dissolution of a firm means the closing down of a partnership business permanently. It happens when the partnership relationship between all partners comes to an end and the firm stops its operations. After dissolution, all assets are sold, liabilities are paid, and the remaining balance, if any, is distributed among the partners according to their capital and profit-sharing ratios. In short, dissolution is equal to end of the firm plus settlement of all accounts. Example: A, B, and C are partners. They decide to stop business. They sell all assets, pay creditors, and distribute the remaining money among themselves. This is called dissolution of the firm. Circumstances, ways under which a firm can be dissolved. 1. Dissolution by agreement, voluntary dissolution. If all the partners agree to end the business, the firm can be dissolved. Example: A and B mutually decide to close the firm. 2. Compulsory dissolution. When the business becomes illegal or impossible to continue, dissolution happens automatically. Example: if a law bans the business activity, like sale of liquor in a state. 3. Dissolution on the happening of certain events. The firm is dissolved automatically when any event mentioned in the partnership deed occurs, such as expiry of the fixed period of partnership, completion of the specific venture for which the firm was formed, death or insolvency of a partner, if the deed says so. 4. Dissolution by notice, in case of partnership at will. If the partnership is at will, any partner can dissolve it by giving written notice to others. 5. Dissolution by court, compulsory by law. The court can order dissolution if a partner becomes insane or permanently incapable. A partner is guilty of misconduct. The firm's business cannot be carried on peacefully or profitably. Easy tip to remember: 5 ways ACHNC. A. Agreement. C. Compulsory. H. Happening of events. N. Notice. C. Court. In short, dissolution ends the life of a firm, everything is settled, and partners part ways peacefully. Next important long question is: 3. The partnership between Raju and Bharat was dissolved on 31st March 2020. On that date, the respective credits to the capitals were Raju 1 lakh rupees and Bharat 60,000 rupees. Bills payable 15,000 rupees and creditors 30,000 rupees. The assets represented by the above realized 1,60,000 rupees. The expenses of realization were 3,000 rupees. Prepare necessary ledger accounts to close the books of the firm with necessary working. Question. The partnership between Raju and Bharat was dissolved on 31st March 2020. Details. Raju's capital 1 lakh rupees. Bharat's capital 60,000 rupees. Bills payable 15,000 rupees. Creditors 30,000 rupees. Assets realized 1,60,000 rupees. Realization expenses 3,000 rupees. Prepare the necessary ledger accounts to close the books of the firm. Step-by-step solution, easy explanation. Step 1. Understand the situation. When the firm is dissolved, we prepare 1. Realization account to find profit-loss on selling assets and paying liabilities. 2. Partners' capital accounts to show distribution of profit-loss and final settlement. 3. Cash bank account to record receipts and payments. Step 2. Prepare realization account. Realization account. To bills payable 15,000 by assets realized 1,60,000. To creditors 30,000. To cash expenses 3,000. To profit transferred to capital ACAs 1,12,000. Total 1,60,000. Working. Realization profit is equal to 1,60,000 rupees, 15,000 rupees plus 30,000 rupees plus 3,000 rupees is equal to 1,12,000 rupees. This profit is shared between Raju and Bharat equally, since no ratio given. So, Raju is equal to 56,000 rupees and Bharat is equal to 56,000 rupees. Step 3. Partners' capital accounts. Particulars. Raju Bharat. To cash, final payment 1,56,000, 1,16,000. By balance BD 1,60,000. By profit on realization 56,000. Total 1,56,000, 1,16,000. Step 4. Cash account. Particulars. To assets realized 1,60,000 by creditors 30,000. By bills payable 15,000. By realization expenses 3,000. By Raju, final payment 1,56,000. By Bharat, final payment 1,16,000. Total 1,60,000. Step 5. Final answer. Profit on realization 1,12,000 rupees. Raju receives 1,56,000 rupees. Bharat receives 1,16,000 rupees. Easy tip to remember. First, sell assets, pay liabilities, record expenses, share profit loss, settle partners. That's the simple way to handle dissolution problems. Next important long question is: for A, B, C share profit in the ratio of a half, 1/6, 1/3, they decided to dissolve the partnership on 31st December 2020 when their balance sheet is as under. Show the necessary accounts. Question. A, B, and C share profits in the ratio a half, 1/6, 1/3. They decided to dissolve the firm on 31st December 2020. Balance sheet before dissolution. Liabilities rupees, assets rupees. Creditors 41,000, cash at bank 5,000. Reserve 6,000, sundry assets 80,000. Capitals A 30,000, goodwill 10,000. B 15,000. C 3,000. Total 95,000. Assets realized, sundry assets 50,000 rupees, goodwill 4,000 rupees. C is insolvent and cannot pay anything. Step 1. Calculate total loss due to CS insolvency. CS capital 3,000 rupees. Loss will be shared by A and B in their profit sharing ratio, A half, 1/6. Step 1A. Find their total ratio excluding C. A, B is equal to a half, 1 divided by 6 equals 3, 1, after simplifying. Step 1B. Allocate CS loss. CS loss is equal to 3,000 rupees. A's share is equal to 3/4 times 3,000 is equal to 2,250 rupees. B's share is equal to 1/4 times 3,000 is equal to 750 rupees. Step 2. Prepare realization account. Realization AC rupees. Realization AC rupees. To sundry assets 80,000 by cash, assets realized 50,000. To goodwill 10,000 by cash, goodwill realized 4,000. To loss on CS capital 3,000 by A's capital, CS share 2,250. By B's capital, CS share 750. To creditors 41,000. To reserve 6,000. Total 1,40,000. Total 1,40,000. Step 3. Partners capital accounts, final settlement. Particulars A rupees, B rupees, C rupees. By balance BD 30,000, 15,000, 3,000. By share of loss on C, 2,250, 750, 0. By cash, final payment 0. Step 3A. Adjust A and B for CS loss. A's effective capital is equal to 30,000 to 2,250 is equal to 27,750. B's effective capital is equal to 15,000 to 750 is equal to 14,250. Step 3B. Pay partners from cash realized. Total cash available is equal to 50,000 plus 4,000 equals 54,000. Deduct creditors and reserve is equal to 54,000, 41,000 plus 6,000 is equal to 7,000 left for partners. Step 3C. Pay partners in their capital ratio. A, B is equal to 27,750, 14,250, 11/6. A's share is equal to 11/17 times 7,000, 4,529 rupees. B's share is equal to 6/17 times 7,000, 2,471 rupees. C gets nothing. Step 4. Summary key points. When a partner is insolvent, his capital loss is shared by remaining partners in the profit-sharing ratio. Assets realized are used first to pay liabilities, then share remaining cash among partners. Always adjust partners' capital accounts for losses due to insolvency before final settlement. Easy tip to remember. Sell assets, pay creditors, share insolvent partners, loss, distribute remaining cash. Next important long question is 5A. B carrying on business in partnership resolve to dissolve the firm and sell off business to A, B Limited. On 31st December 2020 their balance sheet was as under. The agreement with company is as follows. 1. Land and buildings are purchased at 50,000 rupees. 2. Furniture and stock are taken at 10% below book value. 3. Goodwill of the firm valued at 7,500 rupees. 4. Debtors are taken at 8,000 rupees. 5. Purchase consideration is discharged in fully paid shares. You are required to prepare ledger accounts to close the books of the firm. Given. Balance sheet of A and B before dissolution. Liabilities rupees, assets rupees. Creditors 21,250, cash 5,100. Capitals A 34,000 debtors 8,450. B 17,000 stock 15,380. Furniture 3,320. Land and buildings 40,000. Total 72,250. Total 72,250. Agreement with Company A, B Ltd. 1. Land and buildings is equal to 50,000 rupees. 2. Furniture and stock is equal to 10% below book value. 3. Goodwill is equal to 7,500 rupees. 4. Debtors is equal to 8,000 rupees. 5. Purchase consideration in fully paid shares. Step 1. Calculate sale values for assets. 1. Land and buildings 50,000 rupees, agreed. 2. Furniture 3,320 by 90% is equal to 2,988 rupees. 3. Stock 15,380 by 90% is equal to 13,842 rupees. 4. Debtors 8,000 rupees, agreed. 5. Goodwill 7,500 rupees. Total purchase consideration is equal to 50,000 plus 2,988 plus 13,842 plus 8,000 plus 7,500 is equal to 82,330 rupees. Step 2. Prepare realization sale of assets ledger. Journal entries for assets sold to company. Date particulars LF debit rupees credit rupees. 31st December 2020 Bank AC 82,330. To land and building AC 40,000. To furniture AC 3,320. To stock AC 15,380. To debtors AC 8,450. To goodwill AC 7,500. Being assets sold to company as per agreement. Step 2A. Explanation. We credit each asset at book value, debit bank, or company's shares at agreed sale price. The difference, gain or loss, goes to realization AC. Step 3. Calculate gain-loss on assets. Asset book value sale value gain loss. Land and building 40,000 50,000 10,000 gain. Furniture 3,320 2,988 332 loss. Stock 15,380 13,842 1,538 loss. Debtors 8,450 8,450 loss. Goodwill 7,500 7,500 gain. Net gain is equal to 10,000 plus 7,500 332 plus 1,538 plus 450 is equal to 15,180 rupees. Journal entry for gain on realization. Particulars Dr. Cr. Realization AC 15,180. To Ace Capital, 2/3, 10,120. To BS Capital, 1/3, 5,060. Distribution of gain in profit sharing ratio to 1. Step 4. Adjust capital accounts and close books. Journal entry for capital balances and cash received from company, fully paid shares. Particulars Dr. Cr. Ace Capital AC 34,000. BS Capital AC 17,000. To Bank Company AC 51,000 Original Bank. To Realization AC 15,180 Gain distributed. Closing capital accounts after selling assets to company. Step 4A. Explanation. The bank shares received first settle liabilities, remaining distributed to partners' capitals including gain-loss on realization. After all entries, the books are closed. Key points to remember. 1. When selling business to a company. Calculate agreed value for each asset. Compare with book value gain-loss realization AC. 2. Goodwill is included in sale and distributed among partners. 3. Cash or shares received from company settle liabilities first, then partners' capital. 4. Final step, close realization AC and capital AC.